Two investors, same age, same job, same $500 a month, into the exact same boring index fund for 30 years. Investor 1 checks his portfolio every single day, sometimes twice. Investor 2 checks it once a year, same appointment, every January. 30 years later, they compare accounts. They should be identical. Same money, same fund, same market. They're not even close. The man who looked once a year retires with around $300,000 more. $300,000. Not from picking better stocks, not from working harder, from looking less. That sounds impossible. Like a riddle or a scam, it's neither. It's one of the most documented effects in all of investing, and it's happening to millions of people right now, every morning, the moment they open that app. This is the story of the most expensive habit in modern finance, and why your portfolio is the one thing in your life that punishes you for paying attention to it. Meet Investor 1. He does everything the books say. $500 a month, automated, low-cost index fund, no gambling, no crypto casinos, no hot tips from his barber. But he has one small habit. Every morning before coffee, his thumb finds the app. A red number before breakfast, a green number at lunch. One more check before bed, just to see how the day closed. It feels responsible, diligent even. You check your kids, you check your locks, you check your money. What kind of careless person doesn't look at their own life savings? Here's what he doesn't know. Every time that app opens, he's not gathering information. He's rolling dice in a rigged psychological casino, one where the house edge isn't in the market. It's in his own brain, because the market he sees every day and the market that actually exists are two completely different animals. Here's the statistic that changes everything, so listen carefully. Historically, the U.S. stock market finishes green on only about 53% of trading days. Basically a coin flip. Heads you smile, tails you wince, 250 times a year. But zoom out, and the same market finishes green in roughly 3 out of every 4 years. Zoom out further, and over any 20-year stretch in modern history, it has essentially never lost. Same market, same investments. The only thing that changes the picture is the zoom level. The daily checker has front row seats to the coin flips. The yearly checker only sees the seasons. Neither of them is seeing something fake, but one of them is watching static, and the other is watching the signal. And static, it turns out, is expensive because of what it does to the human brain. Psychologists discovered something brutal about how humans process money. Losing feels about twice as strong as winning. A red day stings roughly 2 times harder than a green day of the same size feels good. It's called loss aversion, and it's wired so deep you can't turn it off. Now run the daily checkers year through that math. 53% green days, 1 unit of joy each. 47% red days, 2 units of pain each, added up. And even in a good year, even while his account is growing, his emotional ledger finishes deep in the red. Read that again. His money went up, and his brain experienced the year as a loss. That's the trap. The daily checker isn't weak or irrational. He's a perfectly normal human being, plugged into a feed that's mathematically engineered to make him feel terrible about something that's going well. And people who feel terrible eventually do something about it. Pain demands action. That's its job. So after enough red mornings, the daily checker starts doing things. Small things at first. He skips 1 month's deposit because the market looks shaky. He sells a slice during a dip just to feel in control, and buys back in later, higher. He reads one scary headline too many and sits out the recovery. Each move feels sensible in the moment. Each one has a cost. Researchers have measured this for decades, and the number is remarkably consistent. The average investor underperforms their own funds by roughly 1.5% per year. Not because the funds are bad, because of when they jump in and out of them. They even have a name for it: the behavior gap. The distance between what your investments earn and what you earn after your emotions take their cut. 1.5% sounds tiny. Hold that thought. In a few minutes, I'll show you what it turns into over 30 years. And the number is going to hurt. Now, meet Investor 2. Same salary, same $500 a month, same index fund. His secret weapon is nothing, an empty phone screen. The app isn't on his homepage. There's no price widget, no alerts, no financial news in his feed. Once a year, every January, he sits down with a coffee, opens the account, and spends 20 minutes doing exactly 3 things. He checks that the automation is still running. He rebalances if things have drifted, and he closes the laptop. That's the entire strategy. 20 minutes a year. His coworkers think he's reckless. His brother-in-law, a proud daily checker, calls him lazy with money. But something interesting is happening in his brain. Or rather not happening. No 250 coin flips. No loss aversion tax. No scary Tuesdays. The market's daily tantrums are happening in a room he simply never enters. He didn't outsmart his emotions. He just never gave them the microphone. And here's what the once-a-year investor actually sees over 3 decades. 30 Januaries, 30 snapshots. Of those 30, roughly 22 or 23 are green, because that's what 3 out of 4 years looks like. The red ones, they're real, and some are ugly. But they arrive as a single photograph, not a 6-month horror film he watched frame by frame. Think about what that means. The daily checker and the yearly checker own the same portfolio. They lived through the same crashes, the same recoveries, the same decades. But one of them experienced roughly 7,500 emotional coin flips. And the other experienced 30 calendar photos, most of them smiling. Same movie. One watched it in slow motion with the lights off. The other read the happy plot summary once a year. Guess which one still trusts the plan when the market drops 30%. Guess which one is still in the market on the days that matter most. Because here's the final piece, the one that turns a psychological story into a financial massacre. Decades of market data show something almost cruel. Miss just the 10 best days over several decades of investing, and your final wealth can be cut nearly in half. 10 days out of thousands. That's how concentrated the market's gains are. And here's the cruel twist inside the cruel fact. Those best days don't arrive during calm, sunny stretches. They cluster violently around the worst days, right in the middle of crashes, when the news is apocalyptic and every red morning is screaming, "Get out." Which investor is most likely to be standing outside the market on exactly those days? The one whose brain just absorbed 3 weeks of double-strength daily pain, or the one who won't even hear about the crash until January, by which point the rebound already happened? The daily checker doesn't just feel worse. He's statistically positioned to miss the precise moments that build wealth. So let's write the bill. $500 a month, 30 years. The once-a-year investor captures the market's full historical average. Call it 10%. His finish line, around $1.13 million. The daily checker earns the same market, minus the behavior gap. 10% minus 1.5. His finish line, around $825,000. The difference, roughly $300,000. That's the number from the beginning of this video. Not a trading loss, not bad luck. 300 grand paid out one anxious tap at a time. The most expensive app habit ever invented. And the poetic part, the daily checker worked harder. More attention, more effort, more stress, more hours spent staring at charts for a smaller reward. Investing is one of the only games on earth where the scoreboard punishes you for watching it. Quick honesty break. You know how this channel works. First, the numbers. 10% is the long-term historical average, not a promise. And the 1.5% behavior gap is a well-documented average across millions of investors. Your personal gap could be 0 or worse. Second, you've maybe heard the famous story that a brokerage studied its best-performing accounts and found they belonged to investors who were dead or forgot they had accounts. It's a great story. It's also never been verified, most likely a legend. The verified research says the same thing anyway, so we don't need the myth. Third, and most important, checking daily isn't the crime. Acting on what you see is. If you can look at red every morning and never touch anything, the math doesn't care about your screen time. But decades of data say almost nobody can. The cheapest solution isn't discipline, it's distance. So here's the strange conclusion of this entire series so far. Episode 1 showed you that starting early beats starting rich. Episode 2 mapped every level the machine can climb. Episode 3 proved the hardest part is the boring first stretch. And this one closes the loop. The machine works best when you stop watching it work. Automate the deposit. Delete the widget. Pick one day a year. Make it a small ritual, coffee included. Your portfolio doesn't need your attention. It needs your absence. Because the market pays a premium to exactly one kind of person, the one who can own something valuable and leave it alone. If you're wondering what that patience is actually building toward, watch the 100K video next. It's the moment the whole machine turns on. And then close the app, seriously. Close the app.